Right, good morning. I'm Sean Segar, representing Nedgroup Investments Cash Solutions today, and I'm joined by Ray Wallace, Chief Investment Officer of the Quanta Asset Managers. They're our best-of-breed manager for the Nedgroup Investments Core Income Fund and all our money market funds. So Quanta, as you know, are specialist liquidity and short-term fixed income managers, and they've been managing all of the Cash Solutions funds since each was started. And they're the largest cash managers in South Africa. What we particularly like about them is that they come out of a bank treasury environment. Morning, Ray.
Good morning, Sean, and to everybody else out there. Thanks. Sean, you wanted me to carry on and just, yeah, sure.
Just start by reminding all of those listening about the Quanta's philosophy and style when it comes to managing liquidity.
Sure. Okay. So, as Sean's mentioned, we have a long history with Nedbank. Quanta actually came out of the Nedbank stable and we went independent in about 2007. And really the core of the team comes out of a treasury background. So Steve was treasurer at Cyfritz and I've come out of Standard Bank Treasury. And when we put the business together, it was done from a treasury perspective. And we've used those skills and that positioning to differentiate ourselves from other cash managers over time. So one of the main factors in our philosophy is that we said that we are not economists. We cannot predict where interest rates are going. So for a long time, we've had the view that what we want to do is to provide investors into our funds with consistent returns over time above where the risk-free kind of cash rate is. And that involves then taking a very much a floating rate philosophy. So in other words, most of the assets in our portfolios are of a floating rate nature and always have been. And over that period, over the last sort of 20 years or so, we've been able to outperform the benchmark and stay on the top of the surveys over that entire period because the strategy has just worked. So many of the economists get it wrong so often that we're just saying, look, well, it's not a risk that's worth taking. So it's done us in good stead over the last sort of 20 years or so. And the other aspect of having come out of a treasury is that we've understood that liquidity risk is the biggest risk. Credit is obviously a very important risk, and we've obviously taken out the interest rate risk by having floating rate assets. But really, liquidity is where it really matters. And that's, from a bank's perspective, again, that's something that gets ingrained into you from a very early stage when you join a bank's treasury, is that liquidity is the primary risk in a bank, because if you have a run on a bank, you need to be able to provide the liquidity to your clients. So all of that is the main focus is on our business, is taking out the interest rate risk and concentrating on credit and on liquidity, but mainly liquidity. And so having come into this crisis, it's done us very well in being prepared for that.
Now, on that note, I see Quanta had the core income fund, and in fact, all of the Nedgroup Investments Cash Solutions funds particularly conservatively positioned ahead of the COVID-19 crisis. Can you take us back through your thinking since the beginning of the year when you started implementing this?
Yeah, so we actually started last year. And I think people who went to some of the presentations at the end of last year will remember that we mentioned that we'd already started de-risking the portfolios at that point, because we were very concerned about the upcoming downgrade, and we were pretty convinced that it was going to happen after the budget speech this year. So what we said was that, again, liquidity risk is the major issue. So what we started doing then was to actually ensure that all the instruments in the portfolio, or the majority of them, were of a very liquid and tradable nature. So you'll see a very high percentage to NCDs, and negotiable certificates of deposits with the major banks. And we also said, okay, credit, we don't really want to be in the corporate market. And look, we haven't been in the corporate market to a large extent for a long time, because we don't think that corporate debt is being priced properly in this country. So we've kind of never really been players in the corporate debt space. So it was quite easy to make sure that we remained largely in the big four banks and some international banks. So we're sort of over 98% in banks, major banks. We have a small amount of corporate exposure, which is really of no real consequence. And so we started that process last year already, and it obviously just sort of accelerated as we started coming into the budget period. And our expectation was that the risks of a downgrade were not priced in. All the market was telling us was that, oh, everything's priced in, and it's easy when you've got a lot of younger guys in treasuries and in dealing desks and in hedge funds and stuff who haven't necessarily been through a number of crises before telling you that a downgrade has been priced into the market. In our experience, it never is properly priced in. So we were expecting to have some turmoil in the market. And so we were very lucky to be positioned so conservatively. In fact, we've never been this conservative in the entire history of the way we've managed funds. So when the coronavirus crisis hit us, we were actually perfectly positioned for it. All we really had to do was to go out and just raise a little bit more liquidity just to be 100% sure that we could cover any unexpected withdrawals. And as it's turned out, we've actually ended up with even more cash because we've actually seen flows into the fund. So we're in an extremely good position at the moment where we're sitting on a huge amount of cash, coming into an environment where the index funds for the World Government Bond Index are having to rebalance at the end of April, or it may be a little bit later. I think there were some rumors around them delaying that process, which has really helped with the liquidity crisis in this country. But it's still going to happen, and there will be I believe, another little bit of a mini crisis when that happens, because there will be a liquidity squeeze again. And so, but we prepared for that. And because of the excess cash we have, we actually are able to sit and cherry pick some really good secondary market assets that are out in the market at the moment. So, but we will remain conservative, very conservative in the lead up to that rebalancing process that the index funds will do. So at the moment, other than holding, a government bond, which I'm not sure is that risk-free, you pretty much, there's where the buck stops with the money market funds, because really we invested in the big banks, and that is the real crux of the economy at the moment. So I don't believe you can be more conservatively positioned at the moment.
So heavy exposure to the big five banks, and some breaking news has been that the South African Reserve Bank has started encouraging the banks, the commercial banks, to withhold dividends. Is this a good thing? They're also withholding big bonuses, by the way.
Yeah.
They're be more assertive.
Yeah, so we actually see this as a positive. Basically, what it's saying is that the Reserve Bank understands the importance of the financial system, and all the big banks are systemically important in South Africa. So all the Reserve Bank is doing is going publicly and saying, we understand the importance of the banks, and we want to make sure that the banks don't do anything irresponsible like paying out dividends when they have cash requirements. And so it's really, in our view, it actually strengthens our position in terms of holding mainly bank exposure, because effectively the Reserve Bank is saying that these banks are part of the payment system in South Africa. We can't see any problems happening in this process. We can't let it happen. These banks have to survive, and we are basically suggesting to them that they don't pay out dividends or bonuses to ensure that they protect the liquidity in the system, and they can pay dividends and bonuses later on when we're out of this process. But at the moment, they need to be responsible in terms of retaining liquidity that might be needed in the financial system to keep it robust. So we're very comfortable with that, and we're actually happy that they've come out with that kind of statement. And I think the banks would have done it anyway. I think most of the banks in South Africa are very responsible, and they clearly don't want to see anything happening in that financial system. They've been very supportive of the money market funds and the market in general. So I think this is just really a further indication that the Reserve Bank is in control of the process, and they're actually been very responsible in putting out statements like this.
Ray, how was the recent 100 basis, or how did the recent 100 basis point rate cut on 19th of March impact the core income funds yield?
So the fund was yielding before the rate cut, was yielding in the region, I think, of about 7.74%. We currently, yesterday's estimated yield was 7.64. So that's really only 10 basis points of that 1% has reflected in the yield of the fund so far. Now, obviously, As I mentioned before, we hold mainly floating rate instruments which reprice every 3 months. So the full 100 basis points will reprice into the fund within the next 2.5 months. But it's a gradual reduction in yield over that time. And if you compare it against a call account, the call account would have dropped by 100 basis points immediately on the 9th or the 20th of March.
Call is at 5%, so it's one of the bigger pickups over call that we've seen for some time.
Absolutely. So at the moment, I mean, from a yield perspective and a risk-adjusted yield perspective, a core income fund or a money market fund is the place to be, because you're getting the advantage of having older assets that only reset over the next 3 months, as opposed to all resetting on the day that the cut happens. So there's an advantage, a lag advantage from a yield perspective. And look, we may have another rate cut again soon, and then the advantage might be even bigger, because you still, it depends when that rate cut happens. If it happens in the next month, you'll still be catching up from the previous rate cut, and you will then only start participating in the new rate cut within the next 6 months. So there is an advantage at this point to being in an income or a money market type fund that has these assets that will only reset to the new interest rate over the next 3 to 6 months, if that happens.
If we can just talk about risk for a moment. You recently spelled out in one of your notes that the fund's positioning, you spelled out the risk relative to interest rate risk, credit risk, and liquidity risk. Can you just describe again each of these risks, how they're presenting in the market at the moment, and what's being done by yourself to mitigate against each of these?
Okay. All right. So I'll start with the biggest risk, and that's liquidity. So just to reiterate again, what we've been doing is the two ways that you reduce interest rate liquidity risk in a fund is to make sure that the assets that you hold are of a very high quality that would be easy to sell in a crisis, that they are the types of instruments that you can sell. So if you look at the majority of the instruments in the fund, I think over 60% are bank NCDs. And in our view, after 20, 30 years of experience in this game, bank NCDs are the most liquid asset in the market, in the money market space, because effectively you can put those assets back to the bank. There's obviously a price that you negotiate on those, and the banks will issue a buy-sell spread on that. And like at the moment, they've widened that spread, so they obviously have had to buy back a lot of their assets, and at some point it becomes painful for them to do that. So they will then move the spread out a little bit to make it less enticing for managers to sell the assets back. But you can still sell them back, and the banks will provide liquidity on those assets because they're the ones issuing them. They can take them back, and they need to manage their own liquidity position around that. They don't want to have a situation where they refuse to buy back their NCDs. So that's the quality of instruments. So if you have high quality instruments issued by high quality issuers, then you are able to sell assets at short notice in a crisis. But before you even get to that stage, what you'd prefer to do is to not have to sell assets, and it's to actually have very high quality liquid assets that you can effectively convert to cash very easily, or that are already in call accounts or cash type funds. And so that's something that we started building up from before, or from last year already, where we said we need to start building up the liquidity in these funds. We didn't want to chase yield. I mean, a lot of the income funds were effectively chasing yield because the equity markets were not looking good, bond markets were not looking great, everything in the market was not looking good, and cash and debt funds were looking very attractive from a yield perspective. So what you saw was a heck of a lot of money flowing into income funds, and a lot of guys buying instruments like tier 1 debt and subordinated tier 2. And this has come back to bite a lot of those guys, because those are the instruments that in a crisis like this, where you have a reserve bank that says, look, banks, you need to protect your cash because you need to protect the reserves that you have. The instruments that are going to price the most are going to be those tier 1, because tier 1 assets are effectively convertible to equity. It's a hybrid instrument, and so if any instrument has to go first, if the Reserve Bank has to choose to do something when banks are starting to run out of capital, the first thing they do is go to those tier one instruments and say, sorry, these are loss absorbing instruments, so therefore these are going to be written off or they're going to be converted to equity. Then you go to the tier two debt and you say, those are instruments that literally are able to be written off. They're loss absorbing because the guys who went into those went with their eyes wide open, knowing that should banks get into trouble, these are the instruments that will start absorbing losses before any other instruments like NCDs and senior debt. So those are the instruments, those are the funds that hold those ones are taking a serious amount of pain at the moment because those instruments are currently repricing and they haven't, in my view, they haven't repriced properly yet. There's a huge amount of spread that still needs to be priced into that. So there's going to be capital losses coming from those, I would imagine. So that's that. So providing that liquidity up front is that combination of having cash on hand as well as making sure that your instruments are of high quality. And that ties in with your credit then, because obviously having high quality liquid instruments goes hand in hand with the credit that you have, because obviously it's got to be from issuers that are highly sought after, that are regarded as high quality credits. You don't want to have a whole lot of small corporates in there or property or something like that that's going to be almost impossible to sell in an environment where you need to raise liquidity in a crisis. And then lastly is taking out the credit risk, because although it may seem counterintuitive to have floating rate assets when we think interest rates are going to be declining, it's exactly in an environment like this when people think that interest rates are only going to go down. There's only one direction for interest rates to go. Well, as we've seen in many crises before, that's not necessarily the case. Things may turn around really quickly. So we're not trying to predict that. We're not trying to take bets on where interest rates are going. We've taken out that risk, because floating rate assets have a very, very low modified duration. So they have a very low sensitivity to changes in interest rates. But obviously your rate will come down with them. But having said that, we are giving you a consistent spread above that over time. And you can see from the history of this fund, we've been able to generate over the very long term, at least 100 basis points over Steffi. And at the moment, it's much higher than that. So that consistency, I think, is what's important to institutional investors, to retail clients, to guys who want to know that they're going to be beating cash over time. And so those are the three elements. It's that liquidity, making sure the credit is good to assist with the liquidity, and then making sure that you're not taking interest rate bets where when you thought interest rates were going to be coming down, that they actually turn around and go the other way, and then you make capital losses because interest rates are going up. So that's the three elements.
And while we're on the subject of interest rates, Ray, what is Taquanta's view on interest rates and what is the market pricing in?
So again, we don't like to make predictions on interest rates, but obviously we have a view. So I think, we have to look at various factors. And so one of the instruments, or one of the parts of the market we look at, is the forward rate agreement curve, the FRA curve. And you can see that's pricing in rate cuts going forward. It's moving around a little bit, but the indication is that the market is expecting interest rate cuts over the next couple of quarters. I'm not 100% convinced of that, because I think a lot of the real world consequences have not been priced into the market. We've started seeing, for instance, some of the SOEs now starting to show a lot of pain. They're obviously the ones that will come to the market first, because they're so publicly under stress at the moment that they haven't really got any choice. But I think a lot of the corporates, because they only report earnings and report positions every 6 months at best, you're going to start seeing a lot of that coming through the market. So I think a lot of that stress may be coming through at a later stage, and that may have an impact on what the Reserve Bank does with interest rates. They may actually hold back on interest rate cuts going forward, because it may seem intuitive that in an environment where you have low growth, you want to cut rates. We got rates that are so far above the rest of the world that it seems like an obvious thing that rates need to be just slashed right down to very low levels. But I'm not sure that the Reserve Bank's going to have that luxury, because there are chances that we're going to have to go to the IMF to get loans. The cost of borrowing is going to come. The cost of everything in South Africa is going to be going up. And you may actually start seeing inflation picking up over time. The supply chain system may be affected largely, and there may be increases in basic products that force us to protect the rand, and to protect ourselves against inflation, which would mean that the Reserve Bank won't have the luxury of cutting those rates. So, I'm not going to hold any particular view at the moment. I really need to have more information to do that before we take any view, even though we don't really take views on interest rates. We just say, look, we just carry on doing what we used to do for the last 20 years. We're about giving you a spread above where cash rates are. That's what's important to us. Asset allocations become other decisions in terms of investors. We don't want to make asset allocation decisions for our investors. Let them do that themselves. They can choose whether cash is a good asset versus equity, and we're not going to make that call.
So it sounds like the Reserve Bank's got their hands properly full at the moment, and effectively we've got this quantitative easing going on. And there was this quote floating around that it's quantitative easing is like heroin. You need it in ever-increasing fixes to create a high. Meanwhile, the negative side effects keep increasing. Can you just elaborate on the quantitative easing that's going on and the interventions by the Reserve Bank and the impact on your world?
Yeah, look, I mean, that whole thing about quantitative easing is kind of, in my view, fake news. This is not quantitative easing. This is liquidity easing. This is something that the Reserve Bank didn't have a choice to do, but to provide liquidity into the system. So, you may see bond buying as, in the world market environment, the US going in and buying up distressed assets, and the same thing in Europe. That was quantitative easing in terms of trying to stimulate growth in an economy. This is not about stimulating growth in an economy. This is about protecting the financial system. They didn't have any choice but to go in and buy bonds and to relax the liquidity requirements for banks and the capital requirements for banks. So I don't see this at all as being quantitative easing. It would be fantastic if it was, but it actually has no effect on the growth in the economy. We're way past that point. I mean, this is about survival. This is purely an event or a process from the Reserve Bank to protect the financial system. It's got nothing to do with quantitative easing or trying to stimulate growth in the economy.
Let's just change to the sector at the moment, Ray. We've really seen good flows into the sector. Our range of funds is actually up 16% on the same time last year. We've got a big asset base, lots of liquidity, as you've mentioned. Now, South Africa operates this closed financial system. What are the alternatives for clients that want to park funds in any other low-risk manner or with other liquidity aspects?
Okay, I mean, that's a good question, Sean, because, I mean, ultimately, it comes down to alternatives. What are you going to do with your money? So obviously there's a lot of concern in the market. People are worried about protection of capital, and I mean the sort of the age-old process of that is that you take all of your money out of the markets, regardless of what it is, and you put it in the bank and you hold it on call. So, or you buy gold. I mean, the various alternatives that you can go to try and protect capital in a crisis like this. Unfortunately, this is something I don't think that we've had to deal with for over 100 years, and so the financial markets are way more complex than they were in 1918 when we had the Spanish flu, and world wars and things like that. So we're in a similar kind of environment to that, but we got a very complex investment environment out there. So the alternatives still really come back to some real basic principles of you need to be, how do you hold your capital? Do you put cash under your mattress and do it? Do you hold gold, or do you put money with a bank? Because now we're starting to look at this and saying, where are we safe in the environment? And I think coming back to that previous point that we mentioned earlier on about the Reserve Bank coming out and issuing a statement to the fact that the banks shouldn't be paying out dividends or bonuses for the next while, that again lends credence to the concept that really all, the sort of final or the last bastion of protection is really your government. And I think the banks are so tightly woven into the government's systems that they really can't be allowed to come under any kind of real stress. So in other words, these are parts of the payment system that have to be there. So I think from a from a sort of a modern day place to park cash and to look after your capital of your investments, that the banks really are kind of the last stop in this, practically. And so the option then comes down to the lowest or the most conservative type of investment, which is a core income type of investment or money market. And then do you leave your money in those money markets, or do you actually take them out and put them in the bank? And then if you don't believe in that, then do you put them into gold or something else? So our view is that the instruments that we're holding from the banks are the same types of instruments that any retail or institutional investor would hold if they went directly to the banks. So in our view, there is not really a huge amount of benefit from taking it out of these low-end funds or these conservative type funds, money market and a core income type fund, and moving to the bank, because all that's going to happen is you're going to get a destruction of value by taking it out of an instrument that's giving you a diversified exposure to those same banks, but doing it at over 200 basis points more than you would be able to go and do it at yourself. So from our perspective, we're saying that that's actually a reasonable option for somebody who's looking to protect their capital, is to go into this. Now, look, there may be some complexities in the sense that core income holds instruments that have some term to maturity, so there's some potential spread risk. But I think because these instruments are effectively the last man standing, there's nothing really else to go and sell in the market. So the spreads have moved a little bit, but I don't believe that the spreads are going to necessarily blow out, because effectively if you're saying that spreads are going to blow out in the senior debt space of big banks in the country, then you're saying that the banks themselves are in trouble, and then we've got some serious problems. So I think there will be some spread movement on those, but nothing to be concerned about in the sense that it's going to destroy any kind of value. You're not going to get negative returns over a month or anything like that in any of these kinds of funds, I don't believe. So really, I think it's a good place, a good alternative to taking your money out and putting it with the bank.
You mentioned the other day that your problem is that you're sitting on too much cash at the moment. With these spreads popping a little bit or widening, is that creating an opportunity, and are you going to take advantage of that?
Yeah, absolutely. I mean, it's the best time ever to be sitting on cash and looking to buy assets on the secondary market at the margins. So that's exactly what we're doing. And obviously, like I said, spreads might widen, and then that might create a little reduction in value over time. But I mean, we're talking minuscule amounts as opposed to the value that we would possibly be able to get from cherry picking assets out there in the market. And that's what we've been doing so far. Is there've been a lot of asset managers who under severe pressure, who have to get rid of assets at all costs. And that's contributing to a certain extent to the spread widening, because we're part of that process of actually buying those assets that's at these very high spreads. But we know that the underlying assets we hold are very secure, so we're happy to push spreads forward because we can absorb that. And so it's a fantastic position to be in, to be very liquid and have excess capital available to be able to be picking out these additional assets, because in addition to holding liquidity, we've had this big pool of liquidity. The yield on the fund has not been affected dramatically. We've been able to keep the fund, like I said, it's only dropped 10 basis points since the 100 basis point cut by the SARB. So it's not like we are giving up yield for liquidity. In fact, the opposite is true, because now we have this excess liquidity. We're buying these fantastic assets, and we're actually able to, on the new assets, the excess spread we're getting on the new assets is actually helping to reduce the effect of the 1% cut, because the spreads on these new assets are higher. So it's not going to obviously reduce the entire 1%, but it's certainly going to help slow down and reduce the extent of that 1% cut. So we're very happy that we're in this position of having this excess liquidity. But we still need to be cautious, because there's some headwinds coming our way still. So we need to be cautious.
Last question, Ray, because we're almost done time-wise. I think we need just to have a comment on the downgrades by Moody's and Fitch. Moody's coming on the eve of the lockdown, but some people say that actually softened the blow as opposed to accentuating it.
Yes, yeah. Look, I think that's true. All the real pain was taken after the lockdown announcement. So I think what happened was it took the wind out of the downgrade sales. The market moved. I mean, the R186 traded at something like 13% at one point. And so we've actually seen the spread widening in the bond market before the downgrade because of the coronavirus thing, which in a sense took away a lot of that pain. But it meant that the market was going to move, whether it was from some event like coronavirus or from the downgrade. The market hadn't fully priced that all in. Luckily, the rebalancing was actually delayed. So I'm not sure who makes that call, but they actually delayed the index funds rebalancing from the end of March to the end of April, and that actually helped a huge amount, because I think things could have been far, far worse had we hit the downgrade announcement and then all the index funds had to sell out of their positions, because that would have added a huge amount of liquidity strain on the market, and that actually might have pushed us over the edge. So I think we're very lucky that that happened. I mean, the Fitch downgrade, it's not unexpected. It's wait for more of these things. It's going to come through. We really are in a bad position from a credit perspective as a country, and so I think we just got to expect and live with the fact that we're going to be downgraded for some time, whether we double B plus or double B flat or double B minus. I don't think really going to make a huge amount of difference. It's really about survival.
Ray, thanks so much. Our time is done. Thanks everyone for calling in. We're just very happy that Quanta has handled this whole volatility so well, that we are well positioned. I will say that we are on the edge of our seats, all of us. We're not resting on our laurels at all. The money market and core income funds are remaining conservatively positioned, and there's a lot more proper fund management going on like never before. So very much on our toes. Business continuity working 100% fine, totally seamless from the cash perspective. On the subject of ratings, all our funds ratings were reaffirmed last week by GCR ratings. So we're also very pleased about that. There are going to be 2 more calls this week. Tomorrow at 10 o'clock, Andrew Parsons talking about global property. And on Thursday, also 10 o'clock, Jeremy Lang from Ardebora will be doing the Insights session. Recordings of all of these are available and will be made available to you if you want them. I think the channel is YouTube. So all that remains for me to say is stay well, look after yourselves. We're doing our best to look after your money, keep the capital preservation going with liquidity and yield. Thanks very much.